Let's talk about whether or not this inflation data is going to, in your mind, lead to some kind of real volatility between today and tomorrow.
Yeah, I mean, I think tomorrow is more important. I think PPI has come down nicely, and hopefully that will continue to come down. What's really driving a lot of the CPI stickiness is the services side of inflation. Goods have come down, services still sticky, but I think tomorrow is going to be an important number.
Now, the inflation data is important for the overall narrative because the market is still very, very tied to what's happening with the interest rate picture right now. What do you think is going to happen with rates? Do we feel as though interest rate cuts are in the future at any point this year, or is the inflation picture just too sticky for that to happen?
Yeah, so we see two possible outcomes, and we like to be overweight fixed income because we think it plays out in a better range of outcomes. On the one hand, we could just see more of the same, right? Like equities are doing quite well, earnings just put in a decent beat, and yet, despite high rates and elevated inflation, or we could see softening of inflation, softening of the economy, and that would more likely get the Fed to move more aggressively. But in the former picture, we don't really see Fed eases until later on this year, if things persist the way they are.
Mimi, there are a lot of themes and cross currents in the market right now. I wonder if you might take us through what your word of the day is and why.
Well, we picked inflation because we have a lot of data this week, and I think it's really the forefront driver for policy in our country. We've started to see some of the easing of policy in Europe, and I think we'll see more of that before the U.S. eases, but I don't think we'll see it without seeing some further improvements on the inflation side.
And you mentioned the idea that you're tilted a little bit more towards fixed income as a way to kind of play this environment from a macro perspective versus, say, the equity markets. Can you take us through the strategy of what that involves? Are you buying shorter dated government bonds, longer dated government bonds? Is it corporate credit? Is it high yield? What exactly is the strategy?
So we own a diversified set of bonds. We're still heavily invested in equities. Our investors are long-term, long only. But in order to go overweight in the fixed income side, we took some away from the equities. Diversified set. We're actually short duration versus the index, which has a duration of about 6.8. So a little shorter than that. We're not that keen on the back end, given the deficit pictures, but we do think that the belly of the curve will give you a decent amount of yield and also protection against an economic slowdown.
And is corporate credit attractive right now?
We like corporate credit. We're a bit concerned about some of the spreads, how tight they are right now. We do think that some of that can be explained by the relative cash